Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So we'll start with the chart of the 5-year Treasury yield and its corresponding ETF, the 7 to 10-year Treasury bond ETF. And if we look at this 5-year Treasury yield, we can see that prior to COVID, we were in this 1.3 to 1.8% area. If you go to the right side, you can see that's the 13 to 18 area on the scale. When you're looking at $FVX from the CBOE, it's times 10. So if you want the actual yield, you have to divide by 10. So we can see here we had that move into safety. So yields fell here when we had the COVID crash. And then yields bottomed out for several months, like a year, kind of a rounding bottom there. And then you had the surge. And that was that first surge in February and March when yields surged. And we saw a rotation in the stock market as well when money moved out of techs and some of the high flyers. And so then we get this correction in the 5-year yield, and we started turning up. And look at that acceleration that we're getting here in the second half of September as the 5-year yield gets to around 1%. So if it continues to where it would be back just before COVID, that would be that 1.3 to 1.4% area, or 13, 14 on the chart. And that would be my initial target here. So the call is for rising Treasury yields. And if you look at the lower window, that would mean for lower Treasury bond prices. So there's the 3 to 7-year Treasury bond ETF breaking down, and it looks like it's going to head lower. Now, the next chart here, we're going to go up a level as far as maturity is concerned, and we're going to go to the 10-year Treasury yield. And this is kind of like the big benchmark. This is what everybody watches. And again, this chart is times 10. So on the right hand, you can see 1920. Well, that's 1.9 to 2% as far as the actual 10-year yield is concerned. And the reason I use $TNX is because it is updated during the day. If you use $UST10Y, that's the close-only price, and that's updated at the end of the day, and that has the actual yield. So we can see here that this green zone is my target in that 1.9 to 2% area. So you can see, again, we had the plunge when money moved into bonds, and then a big bottoming process, and then there's the big move higher. And then we had a correction, and this move retraced about 50%. You know, you moved up, you retraced 50%, you hug the rising 200-day moving average there, and look at that surge. So yeah, we're short-term overbought after this big surge, but I think it's a bullish move and argues for the 10-year going towards that 2% area, getting back to normal basically. And then if you look at IEF, the 7 to 10-year Treasury bond ETF, you can see that it is failing near its falling 200-day and turning down. So the call is bearish for bonds and bullish for Treasury yields. So if we look at the TLT and the IEF together, TLT is the 20-plus year Treasury bond ETF. That's the real longer dated one. And you can see here that, you know, there's the big surge in January, started in February, and look at that surge into the COVID high. And then a lot of volatility, and then a decline, a very sharp decline in the Treasury bond, and then a bounce. And then you can see that bounce retraced around 50%. So what I view this as a primary move lower, a secondary move higher, and secondary moves typically retrace 1/3 to 2/3, with 50% being the base case. And then you can see stalling out there and breaking down. So that to me tells me that the TLT is going to move lower. And there you can see the 7 to 10-year Treasury bond already moving lower. Now let's look at the yield curve and what effect we're seeing on the yield curve. Now we're going to use the 10-2 yield curve, and that would be the 2-year yield and the 10-year yield. So what you do is you subtract the level of the 10-year yield from the level of the 2-year yield, and that is your yield curve, which is the third window there. That's the difference between those top two. But what you can see right away is there's the 10-year yield. We already discussed moving up. But look at the 2-year yield. All right, first we had that big surge in June, and then a lot of chop. And then we get this big surge in September, and we're above that June high. In fact, we're at a 52-week high for the 2-year yield, whereas the 10-year yield is yet to get to a 52-week high. So this tells you that the bulk of the action is at the short end. So that 2-year yield is moving up very sharply. And there we can see the yield curve. So it flattened out a bit, and now it is turning up, and the yield curve is widening a little bit. And that seems to be positive for regional banks. First of all, the regional banks seem to like the rise in the 10-year yield. And second of all, they like the rise or the widening yield curve. So you can see this is the regional bank ETF, and it peaked here in March and moved lower into July, and that's when the yield curve moved lower, and also when the 10-year moved lower. And then the 10-year started to base, and you can see the yield curve started to base as well, and so did KRE, and then KRE popped over the past week or so, with the yield curve and with the 2-year yield, and especially with the 10-year yield. So it looks like this breakout in the 10-year yield and this upturn or widening of the yield curve is going to benefit banks, and that's part of a rotation that we're seeing. And this rotation, it's not like actually bearish, I think, for technology and some of the high multiple names, high beta names, but it might put a headwind there for two reasons. First, rising Treasury yields, that's going to affect your DCF. And if your growth rates are high, then that rising Treasury yield is going to weigh on the DCF, the discounted cash flow model. That's fundamentals. But second, you're going to have money moving into banks, and that money is going to be moving into other places than technology. So that might take away from technology. Now, we can quantify this relationship between the 10-year yield and KRE using the correlation coefficient. That's an indicator at stock charts. So here in the top window, I've got the 10-year yield. I've got KRE in the middle window. And down below, I've got the correlation coefficient between the two. So how do they move together or do they move apart? And you can see that this correlation is mostly positive. It had a couple dips into negative territory, but for the most part, there's a positive relationship between regional banks and the 10-year yield, and that means they tend to move in the same direction. So if we think that the 10-year yield is going to move higher, that would also be a bullish argument for the regional bank SPDR KRE. So I want to show you a couple of charts from trendinvestorpro.com, and these are from recent commentaries this week. And the first one I'm going to cover is going to be the Zweig Breadth Thrust because it hit its lowest level since May. And that shows a lot of weakness within the market, broad selling pressure, if you will. And then I want to look at stoke close signals versus price action for a high beta ETF, in particular, one of the ARK ETFs. So here's the article on the Zweig Breadth Thrust, and I basically outlined the signals here. It's a two-step signal, the Zweig Breadth Thrust. So first of all, you need to get below 0.40, and this is advances minus advances plus declines, and it's a 10-day EMA of that. And so Marty Zweig used NYSE data, but this is for data using just stocks in the S&P 500. And this is very important because the S&P 500, 1/3 of the stocks come from the NASDAQ. So if you're using NYSE Breadth data, you're not playing with a full deck. And so according to Zweig, the first step would be a move below 0.40, and that's the setup. And then the subsequent signal is within 10 days if you move above 0.61. But I kind of relaxed that a little bit. I look for the setup, a move below 0.40, which shows strong selling pressure. And you can see the red arrows show when that occurred, and that was the COVID crash. And we had another one in May. And then about a couple of weeks later, we got that bullish surge. And there's that green arrow there. And that's when the bull run started. But what I want to point out is you can see that sometimes we get a bearish setup and a bullish thrust within a week or two. But sometimes you get that bearish setup and you get more selling pressure like we did at the end of 2018. So now I've moved to the most recent chart, and there is the initial thrust that we got there. And look how long that signal lasted. And now we've got this bearish setup here. And if you just use that as a sell signal, it can help keep you out of what might be a COVID crash or a longer pullback like we had in 2015 or in 2018 at the end. So right now, I think this is a sign of pretty strong selling pressure that needs to be observed. It's not a bearish signal, but it tells you to be careful, and we need to wait for that bullish breadth thrust to signal the all clear, so to speak. So I also ran a little back test to test these Zweig Breadth Thrust signals, and I did that from January 2007 until the end of September, and it worked out pretty well, and that's available for subscribers to trendinvestorpro.com. Now moving to rotation, and what I want to focus is on the ARK ETF, the ARK Innovation ETF, because that is kind of their flagship ETF. And I usually use largely a systematic approach when it comes to trading and investing, and I use Stoke close for my signals. And when it goes below 40, that's a bearish signal. So you can see we got a bearish signal here in March for the ARK Innovation ETF. And it's been bearish until late August when we got a bullish signal. But I was looking at the price chart, and the price chart does not seem to be that bullish. And this is one of these times where this discretionary price chart analysis is clashing with what I see systematically from a Stoke close signal, because not all trend following signals work. 60% fail. But if you look at the structure of this price chart, we have this big decline here, and then we have an advance that retraces just over 50%, forms a rising channel, and you break down. And after the breakdown, you get a bounce, and you move lower, and you get a bounce, and you're still below these highs. In fact, you never exceeded the March high, maybe just barely, but you never broke above it. And now we kind of got these lower highs, and then we break supports. It's like a descending triangle. So even though Stoke closed, the indicator down there is bullish, I think this is a bearish chart overall, and I see more signs of selling pressure than buying pressure. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.